Hello students, welcome to the Gnana Deeksha concept-based digital learning on the theme Financial Services in India. I am Mrs. G. Sabita, working as degree lecturer in Commerce, Telangana Social Welfare Residential Degree College for Women, Mahububnagar. Let me express inspired quotation of Dr. B.R. Ambedkar says that cultivation of mind should be the ultimate aim of human existence. Being in the new normal, we should learn online by being safe and staying at home. So let's start our journey by the comprehensive study on evolution of money, introduction of Indian financial system, meaning of financial services, features, objectives, scope of financial services, types of financial services, products, Indian financial services industry analysis, road ahead, conclusion. Let me start with the evolution of money. The history of barter system says that 6000 BC introduced by Mesopotamia tribes. A barter system is an old method of exchange. This system has been used for centuries and long before money was invented. People exchange services and goods for other services and goods in return. The examples of barter system are exchange of rice to cow, fish to pulses, apples to cock. The limitations of barter system are lack of double coincidence of wants, lack of common measure of value, difficulty in transportation of commodities. Lack of double coincidence of wants. For example, it's no longer necessary for the shoemaker to look for a farmer who will buy shoes and at the same time sell him rice. Lack of common measure of value. If A has rice, B has pulses, then it is difficult to decide how much rice is needed to exchange 1 kilogram of pulses. Difficulty in transportation of commodities. For example, it is not easy and without risk for an individual to take heaps of wheat or herd of cattle to a distant market to exchange them for other goods. The limitations of barter system have led to introduction of money. Money in simple term defined as anything that is generally accepted by means of exchange and at the same time acts as a measure and store of value. Author of Wealth for All, Idaho Cointon, quotes that money is always eager and ready to work for anyone who is ready to employ it. We all know that money plays an important role in our life. One side it acts as a tool for wealth creation and on the other side it serves as a savings for satisfying present needs. So why should one start investing? It is universally accepted that investing, saving and creating wealth for future goals will help you to concentrate on present needs. We are living in the world surrounded by uncertainties where jobs are not assured, inflation, pandemic situation, COVID-19. According to the International Monetary Fund, due to COVID-19, global economy is expected to shrink by 3% in 2020, the steepest slowdown since the Great Depression of 1930. Savings and investments go hand in hand, but there is a subtle difference between the two. A disciplined investor creates a balance between the two. The primary objective of savings is capital preservation and the secondary is getting high returns. Examples are savings accounts, certificate of deposits among others, etc. Investing is a process of using capital to generate a safe and acceptable return over a period of time. Investment can include various assets like real estate, gold coins, stocks, mutual funds, etc. The important concept of money is time value of money. Time value of money means the value of rupee today is more than that value of it in the future. So here the formula explains that future value of money can be calculated as where PV present value of money, I interest rate, N stands for number of compounding periods annually. T is the number of years in the tenure. Future value is equal to present value multiplied by 1 plus I divided by N. N multiplied T. For example, if you invest rupees 1 lakh for 5 years at 10% interest, the future value of this 1 lakh will be rupees 1,61,051 can be calculated as per the formula. This formula can be used to analyze different investments over different time periods to make optimal and effective financial decisions. Moving on to the Indian financial system. The financial system enables lenders and borrowers to exchange funds. India has a financial system that is controlled by independent regulators in the sectors of insurance, banking, capital markets, and various service sectors, etc. The Indian financial system comprises of four components: financial institutions, financial markets, financial instruments, financial services. Let us discuss about the financial institutions. A financial institution is a banking or non-banking institution established under certain act to contribute for the economic development by collecting the funds and investing in various productive sectors. Types of financial institutions are banking institutions, non-banking institutions. Banking institutions in Indian banking industry is subject to control of Central Bank, Reserve Bank of India. The RBI as the apex institution organizes, runs, supervises, regulates and develops a monetary system and financial system of the country. The Banking Regulation Act 1949 is legislation in India that states all banking firms will be regulated under this act. Banking institutions are categorized as organized sector and unorganized sector. The organized banks are commercial banks, cooperative banks, regional rural banks, foreign banks. Unorganized banks are indigenous bankers, money lenders, etc. Non-banking financial institutions are non-banking financial company NBFC is a financial institution that does not have full banking license but facilitate bank-related financial services like investment, contractual savings and market brokering and risk pooling. These institutions are not allowed to take deposits from the public. They play a big role in strengthening the economy and have been carved out a place for themselves in meeting the credit needs of both wholesale and retail customers. The non-banking financial institutions include insurance firms, leasing companies, housing finance companies, venture capital and credit rating agency, etc. In consequence of the financial system in India is regulated by independent regulators in the field of banking, insurance, etc. They are Reserve Bank of India, Securities and Exchange Board of India, Insurance Regulatory and Development Authority of India, Pension Fund Regulatory and Development Authority. Let's look into financial markets. Financial markets are a place where buyers and sellers participate in the trade of assets such as equity, bond, currency, etc. Equity is the value of shares issued by a company. Bonds are units of corporate debt issued by companies and securitized as tradable assets. Currency is a medium of exchange for goods and services. Financial markets are divided into money markets and capital markets. Money market is a market dealing in securities of short-term funds whose maturity period is up to 1 year. Example, certificate of deposits, treasury bills, etc. Capital market is a place for issuance and trade of long-term debt, securities and equity investments. It is further categorized as primary market and secondary market. Primary market is where securities are first issued to investors by companies to raise capital. This is called as an initial public offer. A public issue does not limit any entity in investing. In terms of Company Act 2013, an issue becomes public if it results in allotment of more than 200 persons. This means an issue resulting in allotment to less than 200 persons in private placement. Secondary markets refers to a place where securities are traded in stock exchange after being initially offered to the public in the primary market. Secondary markets are divided into over-the-counter market OTC, exchange traded market. OTC is informal markets where trades are negotiated. It is a bilateral contract where two parties agree on how a particular trade or agreement is to be settled in the future. The trading occurs via middlemen called dealers who carry inventories of securities to facilitate the buy and sell orders of investors. Most of the trades in the government sectors are in the OTC markets. Exchange traded market. It is called as auction market where buyers and sellers come to a place and announce the rate at which they are willing to sell or buy securities. Here is an interesting topic, financial instruments. According to Association of Chartered Certified Accountants, a financial instrument is any contract that gives rise to financial assets of one entity and a financial liability or equity instrument of another entity. Financial instruments are divided into derivative instruments and cash instruments. A derivative is an instrument whose value is derived from the value of one or more underlying, which can be commodities, precious metals, currency, bonds, stock indices, etc. Derivative instruments are futures, forward, options, and swaps. Future contract is a contractual agreement between two parties to buy or sell the underlying asset at a predetermined price on a predetermined date. The terms and conditions of the contract are standardized and are determined by the stock exchange. The predetermined date of futures contract is the expiry date before which the parties to the contract have to fulfill their obligation. These are also called as exchange traded contracts. Forward contract is a customized contract between two parties to buy or sell an asset at a specified price on a future date. Forward contracts are over-the-counter instruments. Examples are commodities, currencies. Options. Options contract offer the buyer the possibility to buy or sell depending on the type of contract. There are two parties to the contract. Buyer has a right but not an obligation to fulfill his contractual obligation. Seller has an obligation to fulfill his contractual obligation. They are often used in securities, real estate transactions, etc. Swap. It is an agreement between two counterparties to exchange financial instruments or cash flows or payments for certain time. One party pays a flexible interest rate, the other pays a fixed interest rate. Cash instruments are financial instruments whose values are set directly by markets. Cash instruments can be securities which are readily transferable and cash instruments such as loans and deposits. Loans can be classified as unsecured loans and secured loans. An unsecured loan is a loan that is issued and supported only by credit worthiness rather than by any type of collateral. A secured loan is a loan in which the borrower pledges some asset as a collateral for the loan, which then becomes secured debt owed to the creditor who gives the loan. Let me explain the theme of financial services in India. What do you mean by financial services? Financial services means activities, benefits, and satisfaction connected with the sale of money that offer to users and customers financial related value. Financial services activities involved in the process of converting savings into investments. These services are concerned with the design and delivery of financial instruments and advisory services to individuals and business within the area of banking and related institutions. Personal financial planning, investment, real estate, insurance, mutual funds, etc. Some of the important features of financial services are intangible, proactive, link and people-based services. Financial services are available in intangible form. These cannot be touched or seen. Financial service providers have to depend largely upon the feedback from the public to improve the quality and attractiveness of financial services. Financial services are proactive in nature. These help to visualize the expectations of markets and needs of the customers. Linked financial services act a link between the investor and borrower. People-based services is that marketing of financial services has to people-intensive and performance or quality of service. Objectives: raising funds, promote savings, minimizes risk, economic growth and development. Raising funds. It acts as an efficient tool for raising funds by providing various financial instruments to individuals, investors, corporations and institutions where they can invest their money, thereby raising funds from them. Promote savings. These services provide different types of investment options that can generate savings. A mutual fund is one such option where people can invest and earn high returns with minimum risk. Minimization of risk is an important objective played by financial services. These services help in diversifying the risk, economic growth and development. A financial services helps the growth and development of a country. It provides employment opportunities in a country. The scope of financial services is divided into traditional and modern activities. Traditional activities are divided into fund-based activities and fee-based activities. The basic services which come under fund-based activities are as follows. Underwriting or investment in shares or debentures involves entering into a contract with a person known as underwriter, who may be an individual, partnership or a company, undertaking that in the event of shares or debentures not being subscribed by the public or only a part of them being subscribed. The secondary market is the market where previously issued financial instruments such as bonds and stocks are bought and sold. Financial institutions participate in money market instruments like commercial papers, certificate of deposits, treasury bills, etc. Leasing is a financial arrangement in which an individual or a company pays to use land, plant, property and equipment for a particular period of time. Venture capital is a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. Factoring is a financial transaction and a type of debtor finance in which a business sells its accounts receivables invoice to a third party called factor at a discount. Fee-based activities are based on non-fund activities which include managing capital issue and arrangement of funds. Financial intermediaries manage the public issues of corporate securities like equity, shares, bonds or debentures. Financial intermediaries make the arrangement of funds from financial institutions for the client's project cost or its working capital requirements. Modern activities involves non-fund based activity. Project counseling involves the preparation of the project report to raise funds for starting the project with necessary government approvals. Capital restructuring is to redesign capital structure of the corporate unit so that it can be maintained at the best possible least cost to the firm. Debenture trusteeship. Financial institutions can also get themselves registered to as trustee. As trustee, they are to undertake redress of grievances of debenture holders. Joint venture collaboration helps in structuring the financial collaboration and joint ventures by identifying suitable joint venture partners and preparing joint venture agreements. Portfolio management activity is concerned with employment of cash resources into marketable securities to earn in future. Financial services can also refer to the services and products that money management organizations offer to the public. The major players in the services are banking services are provided by large commercial banks, community banks, credit unions and other entities. Commercial banking services refer to an institution that accepts deposits from the public and advances loans. The term commercial is used to distinguish it from an investment bank, a type of financial service entity which instead of lending money directly to a business, helps business to raise money from other firms in the form of bonds or stock equity. In India, community banking looks very different. Self-help groups are often instituted in which members of the local community join together and pool capital resources for the purpose of lending to members. Credit unions offer higher savings rates and lower rates on loans. Hire purchase is a method of financing of the fixed asset to be purchased on future date. Under this method of financing, the purchase price is paid in installments. Ownership of the asset is transferred after the payment of the last installment. Mutual funds. A mutual fund is a mechanism to pool funds from multiple investors and invest these in securities such as stocks, bonds, money market instruments and other similar assets. Systematic investment plan (SIP) in mutual funds functions in a similar manner as a recurring deposit in a bank. Stock exchange. A stock market, also known as equity market or share market, is an exchange where stock brokers and traders can buy or sell shares, bonds and other securities. The major exchanges in India are National Stock Exchange and Bombay Stock Exchange. Investment banking services provide raising capital, advising in mergers and acquisitions, executing securities, sales and trading, and performing general advisory services. Foreign exchange services are the exchange of one currency for another by governments, businesses, and residents in two different countries. Foreign exchange reserves are assets denominated in a foreign currency that are held by a central bank. These may include foreign currencies, bonds, treasury bills, and other government securities. Investment services are investment, legal services, investment banking services, investment advisory services, underwriting services, financial advisory services, or brokerage firm services. It can focus on creating capital through client investment. Insurance Services of India have 57 insurance companies, 24 are in life insurance business, while 33 are non-life insurance. Among the life insurance company LIC is the sole public sector company. There are 6 public sector insurers in the non-life insurance segment. In addition to this, there is a sole national reinsurer, namely General Insurance Corporation of India, GICRE. Other stakeholders in the Indian insurance market include agents, individuals and corporate brokers, surveyors and third-party administrators servicing health insurance claims. Capital restructuring. Capital restructuring is a corporate operation that involves changing the mixture of debt and equity in a company's capital structure. It performs optimizing profitability or in response to a crisis like bankruptcy, hostile takeover bid, or changing market conditions. Portfolio management. Portfolio management services is a tailor-made professional service offered to cater the investments objective of different investment classes like investment portfolio in stocks, fixed income, debt, cash, structured products and other individual securities. The key elements of portfolio management are effective diversification, active management, cost efficiency, tax efficiency. Let me emphasize on the products they offer. Checking accounts. An account at a financial institution that allows for withdrawals and deposits. Savings accounts. A deposit account held at a bank or other financial institution that safeguards funds and provides a modest interest rate. Money market accounts. Low transaction checking accounts that offer a higher rate in exchange for a higher minimum balance requirement. Certificate of deposits is a time deposit, a financial product commonly sold by banks, thrift institutions and credit unions. CDs differ from savings account in that the CD has a specific fixed term and a fixed interest rate. Mortgages, loans to purchase a home where the collateral is home itself. Home equity loans, loans offered to homeowners where the loan amount is capped at a percentage of the equity that the owner has on the home. Auto loans, loans used to finance the purchase of an automobile. Debit cards issued in association with checking or savings account that allow point of sale purchases that are then deducted from bank balances and ATM withdrawals. Credit cards, unsecured revolving loans that comes with a card and is primarily used for purchases, though some also provide cash advances. The credit card issuer sets a maximum limit that can be charged. Wire transfer, bank transfer or credit transfer is a method of electronic funds transfer from one person or entity to another. Foreign currency exchange is converting one country's currency to another's. Let me explain the Indian financial services industry analysis. According to the Sources of India Brand Equity Foundation, IBEF says that financial services advantage India by growing demand, innovation, policy support, growing penetration. Growing demand. Rising income is driving the demand for financial services across the income brackets. Innovation. India benefits from a large cross-utilization of channels to expand reach of financial services. Policy support. government has approved a new banking licenses and has increased the FDI limit in insurance sector. Government approved 100% FDI for insurance intermediaries. Foreign direct investment in insurance sector could be increased to 74% from 49%. Growing penetration, credit, insurance and investment penetration is rising in rural areas. High net worth individuals' participation is growing in the wealth management segment. India's financial service sector typifies the progress and opportunity of its economy. The sector will grow rapidly out of 2035, driven by rising incomes, heightened government focus on financial inclusion and digital adoption. India's digital payments could pass $1 trillion by 2030. Road ahead in financial services are, according to India Brand Equity Foundation says that India is today one of the most vibrant global economies on the back of robust banking and insurance sectors. India is expected to be fourth largest private wealth market globally by 2028. Wiser Funding, the UK-based fintech firm, has entered Indian market and will tie up with banks and non-banking financial companies, NBFCs, to provide credit risk assessment solutions for target lending to small and medium enterprises, SMEs sectors. Overall, it can be concluded that Indian financial system accelerates the rate and volume of savings in financial services through provision and its effects in mobilization. In the present scenario, the necessity and urgency of digital transformation is required in financial services. Tablet banking to reach the unreachable, to conduct campaigns to gain the trust of the new entrants and individuals to use the digital banking services, to meet global challenges in financial services and to engage in new collaborations. Life is full of surprises, but the biggest one of all is learning what it takes to handle them. Thank you.